Hi, welcome to episode 2 of An Introduction to Investing. This is a co-production of Lighthaven Capital Management and the San Francisco Investors Club. I'm here with two of my friends, Brenda and Amar. My name is Eric Chung, and today we're going to talk about asset types and also potentially get into investing philosophies. So let's talk first about asset types and why it's important. Amar, can you talk a little bit about why it's important to understand the different asset types, and perhaps we could go through a few examples?
Yeah, sure. So when you think about anything that you buy, you have to understand how risky they are. One other way to state it is like, are you guaranteed to get your money back or not? And asset types are essentially structured in a way so you can understand this basic question. For example, take cash. Cash is like you have some money, it doesn't go away, it stays there. You buy a bond, bond is from a company or a country, and as long as the country or the company survives, you will get the bond plus some interest on top of it. Whereas a stock is a ownership which can just go away if the company goes away.
And just to give a few additional examples of the different asset types, there are stocks, fixed income, things like bonds or loans, real estate, commodities, cryptocurrencies, non-US stocks. So it's basically the same as stock except in foreign countries. Alternatives are things like hedge funds, a little bit more esoteric, probably a topic for another day, but you should just know that there are these other types of, what are known as alternative investments. As Amar mentioned, cash, and then also similar to stocks and non-US stocks, there's also foreign exchange, which is basically the cash of other countries.
One thing I did want to say is that, defining an asset is important too. Like, what is an asset? And an asset is just a store of value. So all of these things that we were just talking about, they may be different vehicles of assets, but they're all valuable in their own way. They're all storing their own value. And so which asset you should start with, that doesn't really matter as much as what is your risk appetite and what is your circle of competency.
One of the things I'm guessing that people want to know is, of all these different asset classes, which one can you make the most money from? And I guess two questions. Number one, is that the right question? And I guess I'm kind of leading you a little bit because we talked about risk, and I think I'm pretty much giving it away, but I think you have to look at returns in relation to risk and your competence. But if you could talk about that, Amar, and also just maybe we could delve a little bit deeper into some of these asset classes and what they might be helpful for an ordinary investor.
Yeah, when you think about asset classes and especially where do you want to put your money, you should think about your timelines and the amount of risk you are willing to take. Take an example. You want to buy a home in 3 years. You most probably don't want to put your money in stocks. You want to keep them either in cash or maybe in a very short-term government bond. Whereas if you are saving money for retirement, the thing you are fighting against is inflation, and at that point you most probably want vast majority of your assets in stocks. And so I would say at a high level, where you put your money depends on the timeline and your risk appetite. And I think it is also important to mention the fact that for most normal people, there is cash. You put it in a fixed deposit, and in US, the government guarantees up to $150,000. Whereas if you are in a foreign country, you should also worry about what currency you are saving the money in, because there is a chance that the government is not as stable. For example, if you happen to live in Venezuela, like even cash is not as safe. So that's important to understand.
I wanted to shift gears a little bit and ask you both about what you think about derivatives. And the reason I wanted to ask you this is because when I meet new young investors, what they're attracted to investing in is day trading derivatives. And I have an opinion on that, but I wanted to get your take on it.
I mean, they are very dangerous. Mathematically, the way to think about it is 95% of derivatives, at least in US for stocks, expire worthless. What it means is the money you put in just goes away. So that means most of the people who just buy and hold derivatives would lose their money.
I tend to agree with that, and which is the advice that I offer people who have never invested in before, that start right out the gate with buying call options or investing in futures. I tell them, do you even understand what it is that you're investing in? What is the stock? What are the fundamentals of this company and why? And a lot of times the answer is no, they don't. So that is my thought on derivatives as an early investor.
Let's move on to another topic. Let's talk about investing philosophies. And this is by no means an exhaustive list, but there are a few popular strategies. One that was popularized by Benjamin Graham, we'll call deep value, or you've probably heard the term value investing. A second one is growth investing, or the thing that I specialize in is kind of a variant of growth investing, which is growth at a reasonable price investing. There are some dividend investors, people who want to buy stocks that pay dividends because of the steady income that it provides. There are a lot of traders, and I think trading is a strategy that is very different than the first three that we mentioned. A fifth strategy would be momentum investing. So that's like buying like the hottest growth stock out there. Another popular strategy is a passive investment strategy where you're just investing in index funds and you're not actually trying to pick individual stocks at all or trading. You're just basically putting money into the entire market. A lot of professional investors do what is known as arbitrage. So that's basically finding inefficiencies in the market. And then there's another type of investing philosophy that mostly hedge funds use. They invest in special situations. I don't think we have to go into all of them, but how about you guys? I'd love to hear what your favorite strategy is or what your primary strategy is, and any other thoughts that you might have about investing philosophies. Brenda?
Sure. I tend to go for the growth investing. I'm very optimistic about the future, especially the future of technology companies and of consumer companies. And so I feel like the growth investing strategy is my strategy of choice.
I think of myself as value investor, but I define value investing more broadly, which is buying something that I think is cheaper than what it is worth. So I believe in the statement that, price is what you pay, value is what you get. I think Buffett and Howard Marks keep stating that. So if that company happens to be deep value, like Volkswagen, or like what used to be Valiant, Bosch and Lam, which people think is going to die, but we see a clear chance that they might live. So I buy them. I also buy companies where they are growing really fast. Even though they are considered growth companies, people are not valuing them at that level. For example, Apple 2 years ago was selling for $99 when it was like one of the cheapest companies in the market.
For me, I'm also, I definitely agree with what you're saying that there's actually a lot of people think that there's not a difference between value investing and growth investing. That I also agree with that. Although I do, all the companies that I personally invest in do have growing revenues and earnings. So if you had to categorize me, I definitely would be a growth investor as well. So Amar, we've just gone through a bunch of investment philosophies. Why should investors care about this, and why does it matter?
It matters because each one of us is different. We think differently. We have different strengths, different weaknesses. So you have to pick something that you can stick with and that will work for you, because what works for me might not be what Eric wants, right? So it is really important for people to pick something that they can use for the long term and be successful at.
I think we're out of time for today, but on the next episode, we're going to cover what is fundamental investing and provide an overview of the investment process. And then in future episodes, we're going to walk people through the details of how to invest. And we're thinking about actually basically summarizing a really famous book that we all love. It's One Up on Wall Street by Peter Lynch, and basically making this kind of a virtual book club. So anyway, thanks very much for watching, and stay tuned for our next video. Thanks.